Ed Pinto on our show talk about the almost immeasurable value that the government backstop or implicit guarantee represents for the success of Fannie and Freddie. I mean,
if you really want to change the motivations for spending at the government level, you have to eliminate this ability and a desire to be a career politician.
In a super abundant world, a loaf of bread costs $3 now, but if a robot is farming it and making the bread and whatever, then maybe it's 30 cents or 3 cents or whatever. And that's the idea, I think, generally behind this superabundance that Episode 43 of Market Moves with Mark and Jeff, two uninteresting guys talking about interesting times. Jeff, you have been so busy and pulled in so many directions over the last month. You're bordering on interesting. What gives?
Well, I've narrowed the gap maybe slightly, Mark. I don't think I've cleared the threshold into the interesting category. Oh my gosh, I knew, and I've told my wife, I was like, I just got to get through May, man. I just several different of these volunteer positions we've talked about, and just things going on, with travel for those. And in fact, somebody had said congratulations to me, just seeing a post at a church event, and so somebody else overhearing that leans over and says, "Congratulations for what?" And my description was basically, well, I've been invited to volunteer more time to to contribute to the appraisal profession or whatever. In fact, she used to work in our office, over a decade ago. So was, kind of, in the know with at least appraisal related stuff specifically. She's like, "Oh yeah, one of those things. Okay, well, good luck with that." Was kind of the response.
Yeah. It's, your success is getting in the way of our hobby podcast recording time. So, please work on that.
Boy, yeah, we're recording earlier than usual because of a conflict that I've got wrapping up the time on the state board. And in an interesting scenario, we got a 3-day formal hearing, which has not been the norm, for the experience here. But sometimes you get more than you bargain for on that. But it is really interesting to see how the regulatory and the oversight process works at the state level. And this happens to be involved a potential AMC. It's not even an appraiser action, but you learn a lot in going through it. We've touched on some of that service, and kind of giving back to the profession. And it's not without cost and without sacrifice, but I even in the thick of it, do feel like it's a worthy and a worthwhile endeavor. You want people to be treated fairly and not, punitively unless, circumstances dictate it. You want fair-minded people, involved in these decisions. So I'm striving to be that, even though it's caused us to get up a little bit earlier than normal today.
Well, I think your volunteerism and being around the industry is one of the things that makes the perspective of Market Moves unique and somewhat interesting. So appreciate all you're doing there, and thanks for bringing that to the show here. If interesting is the goal, I don't know if it is. No one outdoes current President Donald Trump. And that can kind of take us into the first topic, which has been a common theme of the Market Moves podcast. Really, since a flurry of guests we had leading up to the election, Ed Pinto from the American Enterprise Institute, Scott DiBiasio, head of government affairs with the Appraisal Institute, and even those from Fannie and Freddie. We have been talking about the potential for privatization since the two candidates kind of came into the picture as it related to real estate and how their policies would affect it. And, the Market Moves trade from the beginning here, not financial advice, has been that should the Republicans take the presidency and take the House and Senate, that privatization really could be on the table here, and what an effect this could have to a very dormant two stocks between Fannie and Freddie sitting out there since conservatorship in 2008. In fact, we had, I'm trying to remember his name, and the one name that I should not forget, former director of FHFA. Help me out really fast.
Mark Calabria.
Mark Calabria, my goodness. But even then, saying that this this conservatorship was never a permanent situation. He was directly involved in the legislation to take them in during the great financial crisis, and yet it's become sort of viewed as semi permanent. So with all of that set up, Jeff, we have Donald Trump getting more and more serious in his social media posts and language regarding the exiting of conservatorship for Fannie and Freddie. What do you think?
Boy, yeah, it's interesting to see the way it's being positioned. We heard recently, some comments from Secretary of Treasury Scott Bessent saying, "Hey, as we try to go forward with this, we don't want to increase the mortgage rate, right?" And so we've pulled up a tweet here that that President Trump put out talking about the desire to move Fannie and Freddie out of conservatorship back into private ownership and operation, while basically what he's saying is maintaining the government's implicit guarantee to backstop those mortgages, in an effort to control the risk, in an effort to keep the interest rate from spiking significantly for mortgage rates, because everybody knows that would be problematic. They're already significantly higher than they were in previous years. And I think their concern with trying to go to, or allow these entities to go back into privatization is if that means a material increase in mortgage rates from where they're at today, that would be viewed as a real negative, not a positive in this effort. So I think they're trying to do it in a thoughtful and effective way that doesn't, have adverse side effects in going through the process, Mark. I hope, that if it plays out, that it plays out that way, but they're at least, thinking through what could be some of the impacts there.
Yeah. I think we heard Ed Pinto on our show talk about, the almost immeasurable value that the government backstop or implicit guarantee represents for the success of Fannie and Freddie. I mean, it is enormous and cannot be overstated, and is likely undercompensated for in Ed's perspective. And I can see the argument for that for sure. And we heard Mark Calabria talk about that, man, I don't know how you do this without those guarantees in place. And I don't know what that is, but what does it really do? If the government, if you exit conservatorship and keep those guarantees in place, do you have less oversight on the risk undertaken by these two, but you backstop the entire risk profile, whatever they take on? It's a bit of a sticky wicket and a complicated scenario to think through.
Yeah, it's such a good point, Mark. It really is. And they went into conservatorship in the first place because of some of the risk that they took on that ultimately ended up being backstopped by the government, whether or not there was, an expressed guarantee back, leading up to the great financial crisis. And so this really seems to be changing the ownership, but not really the operation. And, there's been some concern. And I think as I look at it, there was a real dip in the asset value of residential real estate in the United States, coming out of the financial crisis. But starting in about 2011, if I remember the last graph I saw correctly, pricing bottomed and has been on an increase from then through now. And we're, we've been covering some of the increasing inventories. Pricing has kind of stabilized and bounced around, in the moment, starting to see headlines of, maybe very modest 1 or 2%, decreases in real estate values. But the point is just they've gone through a very long run of very limited risk in the asset that's backstopped the mortgages, in what's been originated that they have the loans against. But if that changes materially going forward, right as they're pulled out or put into privatization out of conservatorship, I don't know that that it's going to be a perfect storm, but it could be problematic where if the risk profile increases, if there is a change in housing values, this may not be the ideal time to pull them out of conservatorship. But if there's still that backstop or that guarantee, the taxpayers will basically insure or bail them out, I think you make a good point. What does that really matter? What's the difference? If they don't really, at the end of the day, bear any risk of going out of business.
Yeah, you bet. Nobody's talked about this sovereign wealth fund and I think I had heard some suggestion that, Bill Ackman, for instance, and we've highlighted his thesis for which seems to be playing out up to this point. It's still a long way to go, but the stock was sitting there at $1.50 or somewhere in that neighborhood, and he's saying that it could easily justify an IPO of somewhere at $30 a pop and in an enormous market cap, of which the U.S. I think the government owns like 20 or 30% of that in whatever warrants or whatever it possesses. I think that's right. I could be off a little bit there. So it could be a dollar grab for an administration that's trying to throw debt repayments in as often as they can. So in that way, kind of getting an asset or liability off the balance sheet, and just actuating some of that could be good. I don't know. And to emphasize, we had Scott Bessent talking about privatization in this necessary requirement in their minds, the administration's minds, in making this happen, and that is not increasing the yields between the risk-free rate, the 10-year treasury, whatever that is, and the mortgage rate. And we've talked about this ad nauseum on this podcast, that spread is higher than it's been in a very, very long time. And we've also talked about why that might be. And a lot of it seems to be tied to increased regulatory costs. And, like these regulatory costs, the cost to do a loan is really what this amounts to, has caused a ton of consolidation in the lending space. My goodness. I was looking at, top lenders 10 years ago to top lenders today and even 5 years ago, and how much it's changing. But you have a ton of consolidation. The big banks, not doing nearly as much lending as some of the others that are out there. And so a lot of this is just kind of trying to keep up with the regulation. But how could the administration try to attack or keep yields at the same or lower during this sort of thing? And Jeff, I think bringing up a graphic that we saw from the Broker Action Coalition, this is just one small example, but as this says, enough is enough. For whatever reason, credit pools were like $14.50, maybe mandated by Fannie Freddie or the powers that be. But those caps were removed and have jumped to $80 or $100 if it's a couple per single pool. It's some 700% increase. And this is just a credit pool, but it's one example of the type of things that happen. And I've certainly talked to people on the credit and title side that talk about these sorts of increases are just enormous. And can they be passed through to the borrower? Sure. That's not great, even if that's what happens. But if your competition isn't passing it through, then you're kind of SOL here by not doing it. So there's that. And then you also hear Bill Pulte talking quite a bit about this mortgage fraud stuff. I've never done it, but I've seen a lot of people do it. I guess I had moved into this like lax mentality that saying you were going to occupy a property as a primary residence and not doing it, feel like it happened a lot out there. The people that say, hey, don't ever sell real estate. You buy a home, you live in it. When it's time to upgrade or move, you keep that other one and rent it out. I see a lot of people that do that sort of thing. And I've wondered, are they refining the other one and moving into, I don't know what they're doing, but they're trying to go after that sort of stuff and root it out. And, I think that it is loan defaults occur much higher when it's not a primary residence. And so understanding that deeply is maybe another way to attack the costliness of loans on average. And so I think there are some things that they can do and they're trying to do to cut regulation, to get stricter in enforcing their own policies that maybe take a stab at this.
Yeah, I think that's right. And really, it's all about risk management and mitigation. And that's a really good example, Mark, of someone who says this is going to be my primary residence, I'm going to live in it, versus an investment property. Because when you fall on hard times, it's much easier to let go or walk away from an investment property that isn't your primary place of residence. And so when that's the case, the risk is priced accordingly. And when there's misrepresentation about the intention of the use for that property, and therefore the risk profile, the pricing should probably be adjusted accordingly. And so, anything that they can do to, like you say, just enforce their own, and current rules and regulations, really, I think can help manage, what the effect would be on interest rates of moving into privatization. And, just as a side note, I see this happen all of the time. We've lived through a lot of this in the appraisal profession, where it's been a very hot topic the last 4 or 5 years, this bias in valuation and appraisal, right? And so there have been a PAVE task force. There have been a lot of things that have come out to try to address that. And before any of that stuff came out, it was already illegal to have bias in valuation. You already had a certification saying that you weren't being biased, and yet it's just this regulatory overlay that there's this perceived problem. How real it is has been debated pretty extensively as well. But so often what I see happen is the failure to enforce what's already on the books or already the policy and procedure results in additional overlays that really wouldn't be necessary if there was just simple enforcement of what's already in place initially. And so there's this layer on effect. And I think that's what we're seeing here on the loan origination side, that's driving costs up, that probably doesn't need to if there's simply a more effective mechanism for monitoring and enforcing what's already on the books in terms of the rules for these various loans.
You bet. Well, Jeff, I think we could pull up the Fannie Mae stock price as sort of the larger and poster child here. This is just the last year, and we've gone from $1.50 to 10 something now. We have had a few folks tell us that they have acquired some stock in these entities early on when we began discussing this. That makes both you and I a little nervous because none of this is financial advice. But in this moment, what I'd like to say in my learnings are that relying on some sort of authority figure making a decision that then changes the story of the stock one way or another is it's played out so far well, but it is a very dangerous way to be investing and is risky. And I think generally timing markets is impossible, especially the more naive we are. And I think even the best get taken with trying to time. If Bill Ackman says this thing can go to 30, there's another 3X out there. But that relies on a whole lot of things taking place that in a second, could Trump change his mind? Maybe. Yeah, I think so.
The first time ever.
And I have found that the only success that I've found in the stock market is investigating and believing in a business being like a business plan being executed and estimating amount of time for that business plan to be executed. And that is my timing, not what the stock price has done or is doing. And at worst, taking wins where you can is, one in the hand is worth two in the bush, right?
Boy, amen to that. What I'm hearing you say is bet on Elon, and in the long run, it works out.
That is essentially what my investing success amounts to.
Well, it has been kind of fun to track the Fannie stock price. Like you say, today, we look like geniuses saying, hey, there's potential upside, and there was, but your perspective on like the risk profile of investing in this way resonates with me too. I mean, tomorrow you look like idiots if there's some stress in the system that says, hey, maybe we can't pull these guys out of conservatorship, or if you start to run into an increase in defaults or something, it could change on a dime, to be sure. I did think it'd be kind of funny for us to pool our resources and maybe invest $20 in Fannie or Freddie or something, just to be able to track it, with maybe a skin cell of skin in the game, just to just to see. But it is interesting to see, kind of how the market's, viewing the prospects in the moment as reflected by the stock price. And if things go, according to plan, certainly there is, some upside there. But to me, it's more interesting what the stock price suggests about kind of the market sentiment about these companies and the trajectory going forward than, staking my future financial and retirement abilities, on these companies specifically. But it's interesting to track, and I wouldn't be surprised to see some big movement, one direction or the other with these guys, depending on what Trump happens to say one day and, just how the market forces evolve going forward.
Yeah, well, Jeff, before we get into a little bit on the housing market and kind of diving into artificial intelligence and maybe a moonshot from me on the appraisal profession as it relates to AI, just kind of continuing on policy, like government federal policy. We talked on the show last episode. I think about some confusion that at least I had. I won't speak for you, but just with regards to this kind of big, beautiful bill, and really feeling like it's quite inconsistent. At least the headlines are indicating that it's quite inconsistent with the deficit cure trajectory and kind of platform that the groups that have come into power have run on here, and it's disappointing. I think from my standpoint, I think yours as well, to see these headlines saying, "Hey, the CBO, Congressional Budget Office," I think is basically what it is, but is estimating some $3 to $4 trillion a year of increase to the deficit for the however long that this thing lasts, and so it's like a doubling of the deficit in over 5 years plus, whatever that is. And I was a little baffled by that. There's been a lot of negative news about the DOGE cuts proposed kind of being ignored by Congress, as making permanent, I guess through a process called rescission. And so, I had some confusion, and I think it's Stephen Miller. I don't remember his exact title in the administration, but has done some work trying to explain, and I think it's been a little bit helpful to me. I don't know if I'm not accepting it as a full explanation. All is good. I understand it. I do think you got a lot of Republicans in Congress that did not run on this platform, and they're still playing the typical game of, look, I ran to get my constituents things, and I got to follow through on those. So maybe that's some of the reason why we've got some of this nastiness. But what Stephen Miller was talking about is that the CBO math is a little squirrely. It serves purposes probably in a lot of ways, but it is leading to some pretty negative headlines. And the 3 to 4 trillion in deficit is really mostly tied to the just keeping the Trump tax cuts from the first term. And that so the CBO assumes that the unpermanent tax cuts don't continue, there is a certain level of revenue expected to be brought in. And so by removing those keeping the tax cuts present, you are removing revenue future revenue that the CBO expected to come in until this is done. I mean, there's some logic to that, I think, Jeff. But what Stephen Miller was pointing out is that, if all it was trying to get the deficit to show from the CBO's forecast, they could raise taxes to 90%, and that would show more income coming in and eliminate the deficit one way or another. And so there are a lot of cuts, certainly, with entitlements, I think, in this process. And then they have made it very clear that DOGE cuts, suggested cuts, are discretionary spending, where the big, beautiful bill only attacks mandatory spending by nature. It can't be attacking the other. So you've seen a lot of headlines this week talking about Congress. I think they're kind of having to, because I think the people are revolting, have to address the DOGE cuts. So I don't know, just a little bit maybe of a deeper understanding. I'm not saying it's okay. In my view, I don't think it is. I think we need to be harder in reducing expense, but maybe providing some understanding of the gap in what you expected to happen and what we're getting.
Yeah, exactly. Well, first of all, I'll bring some breaking news. According to Google, Stephen Miller's current title is the White House Deputy Chief of Staff for Policy and Homeland Security Advisor. So, I mean,
what's that acronym?
It's too many letters. I couldn't even get it all right to pull that off the top of my head. But, it's so interesting to see how this stuff all works, at that level. And as I've listened to, and some of the same podcasts that you have, of those that have been involved, and even like this morning, I saw some headlines around Elon talking about, taking a step back from DOGE and government involvement. And I think frustrated and kind of disillusioned at the difficulty of making permanent these cuts that you've talked about. And they've done certain things, like canceled leases and contracts that will be going forward. But there's a lot of this stuff that gets, ultimately gets litigated. I saw another headline, just on that topic of today, a panel of judges, declaring the tariffs, like unconstitutional, or like not enforceable. Now that'll play out, and who knows, where that settles. But there's just, once you think a decision's made in government, it's not necessarily made, and sometimes it can take a long time before it actually is. So for these spending cuts, to actually be implemented and permanent going forward, there's just a lot of back and forth that ends up taking place. But to go from Elon's projection of saving $1 to $2 trillion in the budget to a fraction of that, to date, and not a real clear path to, approaching anywhere near those numbers it is disappointing, and it's frustrating. I think it speaks to the credit risk that, we saw that the government's credit rating, recently reduced by Moody's, and, that can be construed as political. It probably is at some level or in some way, but seeing how hard it is for the government to actually stop spending money does make me step back at a minimum and look at this and say, well, crap, even if there's a will to not spend as much, we're still spending way more. We're spending as though we were still in pandemic, times with, with real issues on the horizon. And I just don't think that's the reality that we're living in, but we're still spending as though it were. And to pull that spending back is, literally takes an act of Congress, and Congress doesn't have the will to, or doesn't see this as, immediately impactful or as big of an issue as I think it probably is. I think, as I've thought about a little bit about this, Mark, I think what is ultimately going to get them to move is the market, voting or saying, hey, U.S. government, this is a problem, and we're not going to price, we're going to demand higher interest rates. And if they have to start refinancing a lot of these bonds at 5 or 6% versus the 3 or 3.5% that they're at currently, I think it's not until, there's not really an alternative action or pathway forward. They're not until they're backed into a corner, or is there really going to be the will for both sides of the aisle to come together to make the necessary changes? It's unfortunate that that's the case, because I think it's like putting off the medical treatment. The longer you let, the illness go, the worse the treatment ultimately has to be. And I think there's a pathway to minimize that, but there's not the will to do it in the moment. It sure doesn't seem.
Well, yeah, I think that the market seems to be speaking in the way you're talking about, Jeff. I think the bond market has gone unexpectedly bad. When the U.S. Goes to auction weekly to sell bonds, they are seeing a market reduction in demand and having to increase rates. And this goes back to that credit default swap bet that's not available to you or I, but I think was an informative, the suggestion of that trade, betting against business loans made, knowing that there is revenue or net income kind of caveats there, that carve outs or whatever that blow up the loan if certain things go sideways for a quarter. And these tariffs are certainly going to make that happen. And what do you do in that trade that we talked about several times on this podcast is winning big, which is certainly concerning. And I'll say that I've said before, I follow Elon really closely for a variety of reasons, and I don't read that I'll never know, but I don't read that he entirely got out of DOGE because he was just fed up and saw no action. I mean, this special government employee thing is only 130 days. What is notable, though, is he's let that narrative go. He's really not addressed it and sort of fed into it. Whether it is the reason that he got out or not, but I think I know and you know that he's got a ton of really critical business moments here that this robotaxi thing launching, the SpaceX flights this week, and on that are important for business success. And so I think maybe the plan all along is to be doing that. But his comments in perspective is certainly ridiculous, no matter what. I think it is proven that despite being ridiculous, probably has a lot of weight, some of his views. But partly his description of leaving DOGE is like, look, cuts are good and necessary, but if we're going to save the country from bankruptcy, US or global GDP is going to have to increase tremendously. So I'm going to go work on that. And as ridiculous as that is, Jeff, that is robots and real world artificial intelligence on a number of levels in his mind. And, so I do think it all kind of ties together one way or another. But David Freeberg and Chamath on our favorite, the podcast's favorite podcast, All In, talked about, David Freeberg has been extremely concerned about the deficit and a deficit spiral that leads to bankruptcy. It's the Ray Dalio changing world order, and credit is really what determines these cycles in world powers. But he even said on most recent podcasts that artificial intelligence could raise global GDP in such a way that our deficit is sort of meaningless. It's a wild thought, but someone that's been so hard on our deficit and fixing it, to say that was really interesting to me.
Yeah, that stood out to me too. My takeaway on that is it's a bet on the future, and there's not a will to do something different. One of my real takeaways, because you're right, David Freeberg in particular has been beating that drum for a long time. And I think the only way that you would really have a meaningful change, because he talks about going back to Washington, meeting with senators, everybody, only tacitly acknowledging, yeah, there's a spending problem, but way more focused on what can I get for my constituents in terms of, projects, government spending in my area versus, it going to someone else's. And to me, and I especially listening to a couple of these most recent podcasts, the takeaway has been that if you really want to change the motivations for spending at the government level, you have to eliminate this ability and a desire to be a career politician. And they talk about this, right? Like this limited service and then going back to the private sector, kind of what Elon's doing on a very truncated timetable. But, term limits or eliminating the incentive to try to entrench yourself by voting your constituents as much spending as possible. If you have a known expiration date and you're there to serve rather than, to try to be self-serving and preserving a career in politics or whatever, that was one of my real takeaways listening to a few of those is until there's a desire to change the incentive structure, I think you're going to continue to get, what you've got. And you couple that with, until it's a crisis, I don't think that, that's the only other incentive that might, spark a move. And if the bond market continues in the direction that you've just laid out, that will, lead pretty quickly, I think, to mandatory, changes in spending and what's going on. But that was what interesting to kind of think about. Why are we where we are? And it seems to be, those that have been in government for a really long time continue to stay in government by, trying to appease their voter base by bringing in projects. Look what I've done for you, and you continue to vote and keep me in. So, I mean, it is what it is as far as the way that the system's constructed currently. I think that some change is probably, would be a net benefit and positive, but I don't know where that will is going to come from to implement that change.
Yeah, it's interesting, Jeff, and I think one possible result of the madness that's here is that bonds move in such a way that it forces the Fed to increase the Fed funds rate, not decrease. And what on earth does that do to the real estate market? I think we can take a sidestep detour to some of the larger conversations we're covering on this podcast today to just talk about a little bit of Redfin data that's talking about the rental market, I think, here, Jeff. And it's certainly the short-term rental market. You've got anecdotes of things kind of nasty out there, and buying short-term rentals at the height of COVID may be a tough prospect today. But what's the Redfin data showing us?
Yeah, you bet. So they put out, in fact, just for those that are interested, they have pretty interesting reporting. I haven't spent as much time on their website as I probably should have, but I found a few very interesting articles, from rental to home pricing and, all of that sort of thing. There were a couple of charts that they put out in a recent article just highlighting the change in rental rates across the country. This first one that's up is showing the percentage change. So you can see, from where this graph starts in July of 2020, you had, and this is year over year percentage change. And at the peak, in around mid or early 2022, you had almost, you had between the 15 and 20, about an 18% increase year over year. And then that's dropped off. And the point of this article was that most recently there was a 1% drop in rental rates year over year. The next chart is actually a little bit more, I think, tells a cleaner picture as to where actual asking rental rates are today versus where they started in July of 2019 on this particular chart, but started around $1,350 a month for an asking rent, are currently up to $1,625 a month, for the asking rent. So it's off from the peak, but it's still much higher than it was, pre-pandemic. And the question is there a meaningful change on the horizon, with this data or not? And it remains to be seen. But the increases aren't there anymore. Does it result in a meaningful improvement in affordability going forward? I don't know yet, but it's at least stopped increasing and kind of hovering, around those levels. You mentioned the short-term rentals, and I increasingly am seeing people saying, "Well, I bought this short-term rental expecting to make all of this money," and they see a top-line revenue number. If I can get however many dollars per night and I can rent it this many nights, I'm going to make all of this money, without adequately accounting for all of the expenses that go into running that operation. And I think a lot have been disillusioned. I think that occupancies have gone down from where they were in the height of the pandemic, and kind of staycation or COVID style travel and that sort of thing. And so it's dropped off as well.
Excellent. Well, not excellent, I guess, but consider the topic covered. It is nasty out there. Just mortgage applications are not doing well. Interest rates are at that magical 7% number, hovering just below and just above. I've seen suggestions that the reinstatement of student loan payments is hitting credit scores negatively in a big way, because people that can't pay them or whatever. And I mean, real noticeable differences in credit scores and what you're eligible to buy. So now you're weakening the ability to borrow an already wildly expensive mortgage on a wildly appreciated home price. So this is all downward pressure stuff. We've seen a lot of it, and something's got to give. And we talked in January about the Trump bump in mortgage applications, Jeff, and I'm starting to think that at minimum we've got a Trump hump that we've got to get over here, because there are intentional bumps in the road that we have to navigate over. And if things go right, I think it's a beautiful runway for us for the next several years. But it could, it's a real risk. It could go real wrong.
It really could. It feels like that light at the end of the tunnel. Just you see it and you never quite get to it. And that has been the story of real estate for the last several years. But yeah, I think you're right, Mark. I think that there will be an increase in transactions, because historically we're at very low transaction rates by volume. There will be an increase, but to your point, I mean, with something giving, it's either going to be interest rates or the home prices, the value of the assets. unless you see a pathway to, meaningful increase in incomes, and it's kind of at the on the micro level, what we're talking about at the macro level with the economy and the federal budget. If GDP grows significantly, the deficit, looks a lot different. If household incomes grow significantly, then the home price and the interest rates, look a lot different. I don't know that I see a path in the short term to that happening. And so if that doesn't happen, the only other thing really to give is home price or interest rate. And I don't know that I'm really seeing a pathway to interest rates, giving meaningfully. I am seeing headlines. In fact, Redfin, the CEO put out an expectation of home price decreases, year over year. We'll see how it goes, but it's kind of boils down to that in my mind.
Yeah, very good. Well, Jeff, we probably have about 15 minutes left in our recording here. If you've made it this far, dear listener, thank you, and hopefully it's worth it. But we haven't talked about artificial intelligence in several episodes, and this is I think this conversation is kind of a segue for the negative prospect and certainly the depression level state that the real estate professional has been in for a really long time and is just unimaginably still exists today. I had a conversation with an appraiser this week, and they the question was mid-60s. Mark, I'm thinking about getting out. I haven't gotten a call from anybody for an appraisal order all freaking year. And I did well enough. I mean, I survived last year, but, we got these new forms coming. We've got AI out there. I'm thinking of just getting out. What should I do? And the appraiser didn't say they were desperate in any way, but you could feel the urgency of, look, I got to make the right decision here. And holding on for another 12 months in this isn't an option. And so, and how many real estate professionals, and I think this is true for mortgage brokers, loan officers, realtors, appraisers, things have changed so dramatically, and we are sitting here in a depression level volume for so long that, I was looking up, man, well, are we going to come out of this just in time for artificial intelligence to kind of eat whatever we were doing or could have done? It's a really difficult prospect. And here we have the Anthropic CEO this week that verbatim, AI could wipe out half of all entry-level white-collar jobs and spike unemployment to 10-20% within the next 5 years. Governments and companies need to stop sugarcoating what they know is coming. And, it's been a little bit quieter on the layoff front. And I think there's been some realization that AI is all right, it's a long ways away from becoming a lawyer for you. It tried to write case law and whatever lawyers do, and those things were found to be misquoted, and all sorts of problems there. But as I listen to interviews of Google's CEO, Microsoft's CEO, OpenAI's CEO, Elon, it is clear. I think there is the pace of advancement that they're watching under the hood. Maybe not just the stuff that's publicly available. It is a man, and I think we as the general public take for granted this amazing discovery that occurred that didn't have to occur, which is large language models, that we can throw the universe of information from the web and wherever into a system that then can accurately predict the next token. And it just is truly amazing what we've seen so far, and that is advancing really quickly. So I'll stop there for a second, Jeff, because I've got a little bit more to talk about. But it does feel like, generally speaking, we've got the Tesla robots that were on display. I mean, there's just a lot happening right now that could affect our daily lives.
It's definitely going to. I think it may be affecting us in ways that we're not fully recognizing. I find myself all the time saying, yeah, this AI task that I tried to give it, maybe it didn't do it perfectly, or I had to, iterate with it multiple times, but it's gotten better. And the expectation is it's going to continue to get better. And just to your point, Mark, of, it's easy to take for granted, what's been done in this LLM model and environment. And it's a little bit, I don't even know what the right word is, but it is just interesting, if nothing else, to think that we kind of collectively have this expectation that, yeah, it's going to continue to increase and get better at an increasing rate, and almost take that for granted. I mean, but when you look at the level of investment that's taking place in the United States and around the world in data centers, in electricity generation, you and I were messaging back and forth, and was it Google or Microsoft CEO that said that one of the bottlenecks was electricians, like physical electricians to wire and like install these these data centers. It just speaks to the rate at which and the investment with which is being made to facilitate this going forward. And knowing what 5 years looks like is hard to know, but knowing that it's going to be dramatically different from today is almost a given at the same time.
Yeah, I think always when life is generally proving out to me to be the opposite of the assumed result. Whatever it is, it's just the way you just can't. There's so many variables. You can't imagine how this stuff all plays out. And you noted this as a bit of an aside, but it really did catch my eye that, and I hadn't seen this anywhere. In that I think it was Sundar's interview, the CEO of Google, was saying that spinning up data centers, which all we've heard about, I mean, these things are flying up everywhere, that the key delay right now is not GPUs and electricity. It is electricians. It is a trade that is out there. That is the last thing that I would have thought. I don't know. I mean, I've got no clue, but I don't imagine that robots are going to set up these data centers instead of humans in any sort of near term. And so I think I don't think people needing these data centers are thinking that either. I mean, what I'm hearing as a result of this is, how do we create like 10x more electricians than we have today? Like, we're going to need it, and we are not graduating. And so here is a kind of a archaic profession in the same way that a appraiser is archaic profession, but we've got like an increase, an unforeseen increase in demand. So go with me on this, Jeff. So the thought generally is that we've got Tesla robotaxis launching. Waymo's given like 700,000 rides a month right now in a car that has no driver, Uber style. I think Tesla is about to come in 100 or 1000x the number of rides given. So that's going to become a normal thing. And that has some interesting impacts, but smaller. But then you've got this humanoid robot that is not creating a capability to perform labor in the marketplace if the real estate is designed to let that thing come in and work, but really to work in the world that exists today. And so what people talk about with artificial intelligence all the way through, whether it's Tesla robot or LLMs or whatever, is this idea that superabundance takes place. And I think I see the path to that if this stuff keeps developing. You need a ton of electricity for it, which is why you need electricians. But in a superabundant world, a loaf of bread costs $3 now. But if a robot is farming it and making the bread and whatever, then maybe it's 30 cents or 3 cents or whatever. And that's the idea, I think, generally behind this superabundance, that everybody has access to everything for very, very little dollars. And so the moonshot here, Jeff, is, and I'm not saying I believe this, but at least it can be a rosy picture for real estate and appraiser profession to look at, in the same way that electricians are rising in need right now. Is that in a superabundant world, there aren't a lot of assets left, because everything is just inexpensive and accessible. But real estate, I have seen a lot of people hedge or suggest that a hedge in a drastically changed economy, that buying land, some have suggested like acreage in rural settings because people can work remotely and don't need to live in the big cities. I've seen others just like prime real estate. There's only so much coastal land that someone can buy or whatever. But I think it's a really easy conclusion to get to, that real estate is one of the last meaningful asset classes in that wild world. And so where appraisers are all and real estate professionals all that there might be a higher demand for our valuations and judgments on real estate values in a superabundant world, where owning real estate is the most important thing, and paying for the right price and that sort of stuff. And in those worlds, in markets like that, I'm not sure that computers are going to get at the next step of value that it takes to acquire those and that sort of thing. So could there, in a way that electricians are to me, a very unexpected high demand all of a sudden, and now we've got to go produce a whole bunch extra of them. Is there some scenario, maybe it's a 1% scenario, where this could be a saving grace for us?
It's such an interesting thing to think through, but a couple of points I think that you make that are right on target is real estate is a fixed asset. Now, like there's not more of it. Now, its use can change and evolve with markets and changing population and tastes and preferences and where people want to live and how they want to work and all those sorts of things. But the change in the potential uses of real estate, I think, is good for appraisers. I mean, for appraisers, but for the real estate professionals that are involved in selling it and that sort of thing too. It's really interesting that in the ways that you may not expect, like this booming demand for electricians, could there be a booming demand for valuation professionals for real property? Yeah, I think that definitely can make sense in this future world going forward. Now, will the electricians and will the appraisers and others that may have a booming demand in time be supported by and augmented by and made more productive by artificial intelligence, by robots, by things that can do certain parts for them? I think both of those things can be true, at the same time, that there's demand for more of them, but even in that world, they can be more productive and more effective than we are today. Really an interesting concept, being tied to an asset class that isn't going away as a result of artificial intelligence and evolving technologies doesn't seem like a bad bet to place, going forward. You and I have talked about what would we tell kids to go into. Hard to know, and I don't know that I've got the right answers, but at least in principle, being affiliated with or working in a space that's tied to an asset that isn't going away, that isn't might change and evolve somewhat as far as the needs and uses and applications, doesn't seem like a bad place to align yourself, whether at the beginning of a career or for those that are currently in it. There's a lot of doom and gloom, and there's been a lot of pain in the last few years in real estate generally, but your kind of picture of the world in the future doesn't look gloomy for those that are in the real estate space. And I mean, of course, you and I are in that, so there's probably a little bit of bias in wanting it to be that way at some level. But even stepping back from that, it's hard to argue that there's going to be a need for those that understand the value and can articulate that well, for well into the future.
Yeah, I think tools make it the case that less appraisers are going to be needed than now. That would be my expectation. But I think that it's also possible that there is an increased value in our judgments because the increased value in the asset as it serves society is an interesting prospect one way or another. So there's just so much to navigate. Nobody knows, but I think the electricians is a story to hang on to a little bit, because the world is changing in ways that are completely unpredictable, and there are enormous variables in a plethora of them, and how they all interact with one another. I don't know. I don't know, but it's not. In fact, it's most common, not the most obvious trajectory.
Yeah, boy, that's so true. And so much of what you expect to happen turns out to play out differently. When the pandemic set on, I thought for sure that home values were going to decrease, that nobody was going to transact. And, part of that was, part of the reason it went the opposite direction of values up and a lot more transactions than anticipated were the result of government actions. But I didn't anticipate that, and so what else will happen in ways that we don't anticipate? It's kind of what makes it fun to look to the future and not be, just pessimistic. I see and know some that are, and that's just not an inspiring way to live or look at the world.
So, Jeff, I think it is the endorsed, although not financial advice, Market Moves quest to create Deca millionaires is to 30x your GSE trades and parlay that into land investment. Is that what we're seeing here?
that feels good to me. And if I can get to deck a millionaire from the $10 or $20 I have to invest today, let's do it, Mark. I'm ready.
Superabundance, Jeff. It can mean money too, right? It can be superabundant money. Appreciate that. A lot more topics we could get to, and I just got back from a trip to a Canadian appraisal conference and some interesting findings there. We can talk about that on the next episode or whenever we get to. But as always, enjoy the time with you in brainstorming and spitballing what this world's going to look like here.
Boy, it's a lot of fun to think about what the future may hold. None of us know for sure, but I prefer to look for opportunity as opposed to just reasons to be negative about what's going forward. And I think that's, kind of, at the heart of where we're at with market moves. So we'll keep scheming up what the future might look like and bring you our iterations next week.
I feel for all of those real estate professionals and appraisers, and you or I are not subject or not immune to the struggles that are there. It has been so difficult the last several years, and all this AI and change that's here in new forms in the appraisal community. These things just add on to the uncertainty and unknown. So it's difficult, and I certainly feel the pain and the difficulty and the struggle with everybody. So maybe this is cathartic market moves. I don't know.
I hope so, if nothing else. And maybe Canada has the answer. So people have to tune in next week to find out.
Sounds good. All righty, Jeff.
Take care, Mark.